Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping, 4% credit card fees, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 15,000 new customers who have recently made the switch to SD Bullion. Why pay more?
Hey everyone, this is Elijah Johnson with FinanceAndLiberty.com, and back with us today is Alistair McLeod from GoldMoney.com and also FinanceAndEconomics.org. Alistair, thank you so much for joining us today.
That's my pleasure, Elijah.
All right, well, I'd first like to discuss a little bit about the precious metal markets. You've recently stated that it looks like a new bull market is starting in gold and silver. Did you want to discuss a little bit about this?
Yes, I think that the thing that really indicates that it may be the start of a new bull market is the developing weakness in the dollar. Not so much measured against other currencies. The yen has been particularly strong. Sterling has been weak. The dollar has been moving more or less sideways against the euro. Though there are signs of weakening in the euro. But predominantly the dollar, I think, has been weak against commodities as a whole. I mean, you see that crude bottomed around about $26, $27. It's now around about 33. Gold is up 15% this year. It's up a bit more than that if you go from the lows in December. So all in all, there are signs, I think, that there is a change, a turn round, if you like, which is in favor of commodities as a whole and against the dollar. So it's potential dollar weakness that I would cite as the main reason for turning bullish on gold.
So with your work at Gold Money, what kind of demand have you been seeing? I know also Gold Money, I believe, also runs BitGold. So what kind of demand have you been seeing at Gold Money? And also, what kind of demand have you been seeing for BitGold since the beginning of the year?
Well, as far as Gold Money is concerned, it was quiet but picking up a bit in January, and February was actually quite a good month for us. As far as BitGold is concerned, that's a fairly new kid on the block. So, I don't really have previous years and things like that to compare with. What we're looking at there is a company which is a new concept, which is actually growing very, very rapidly. I mean, this morning, it released its key performance figures, and I think, if anybody is interested, go onto the BitGold website, look through the investor relations, look for the investor relations menu, and you'll find the latest announcement there. But basically, we've now, in about, I suppose, 9 months or so, gone from zero to nearly 740,000 accounts, which is a phenomenal growth. And this rate of growth is faster in the first year than any of the other internet startups that I'm aware of. I mean, we know about the Facebooks of this world. They actually took a little while to get going before they really got their momentum. This one seems to have its momentum from the start, and its appeal is global. I mean, we've got people in virtually every country who've signed up. Where it's legal for them to sign up, they've signed up. So it's very, very impressive. And I think the important thing, as far as I'm concerned, is that it brings sound money back into circulation. Basically, I'm not so much a gold nut. I'm a sound money nut, if you like. So that is what I want to see. I'm seeing it happen, and I'm absolutely delighted.
Now, you were talking about a little bit earlier that you see that it's the weakness of the dollar that is causing precious metals to rise. I know in a recent article you said that the U.S. dollar seems to have topped. Did you want to talk a little bit about this?
Yes, I mean, I think it sort of rather coincided with in December when the Fed raised the interest rates, the Fed funds rate by, it was a quarter or something. Very soon afterwards, it became absolutely apparent that they'd made the wrong move, and the economic conditions didn't warrant it. Now, admittedly, the Fed is looking forward towards a potential inflation rate at some stage in the future. And having seen commodities fall very heavily, That has depressed the rate of inflation in the States. All you needed was for commodities to stop falling for, let's say, 6 or 7 months, and you would find that the inflation rate would actually pick up. I think that is what really was concerning the Fed, though they were using the excuse of, the employment numbers were encouraging and all the rest of it. But surely the Fed knows that the employment figures are actually pretty rubbishy. And I think they were really more concentrated on the inflation outlook. Now, that being said, the poor performance of the global economy, which is evidenced by a significant contraction in global trade, is beginning to affect the US domestic economy. We see this in all the surveys and various other statistics, if not the statistics produced by official government departments as such. And so, as far as the dollar is concerned, the prospect of rising interest rates through 2016, which the Fed has stated was their forward-looking policy, that has been put on hold. And the market is now beginning to talk about perhaps the Fed might even have to consider negative interest rates. Now, that is the thing I think that is taking the steam out of the dollar. The other thing is that China is doing some interesting things. The analysis, I think, from the Western financial markets is that China has a credit bubble which is bursting, and they're in real deep trouble, and it is going to be awful, and they're going to have to devalue the yuan very substantially. If, however, you talk to the Chinese authorities and the people who are close to the Chinese authorities, the people who can see what China is doing in terms of economic planning, what they are doing is they want to see the legacy industries which were manufacturing cheap goods for the rest of the world. They want to see those effectively redeployed towards higher tech, more consumer-orientated businesses, and at the same time, they want to invest substantial amounts of money, and we're talking about trillions of dollars equivalent, into developing the infrastructure for Asia as a whole. So we have a situation where the Chinese are likely, and I think this is not only likely, but I think is actually going to be happening in the coming months. China will start stockpiling again the raw materials she needs for those infrastructure plans. Now, how does she pay for it? She sells dollars. So I think what you're going to see is a very big switch worth at least $1 trillion, maybe more, out of dollars into commodities. And to my way of thinking, that again reinforces the bear market for the dollar. So all these factors coming into play at the same time tells me that the prospects for gold priced in dollars are actually quite good.
Now, I'd like to discuss a little bit about negative interest rates. You recently wrote an article about negative interest rates, and you said that negative interest rates could cause a lot of inflation in the United States if the Fed were to implement negative interest rates. You said that since the crisis of 2008, the amount of money in circulation has increased tremendously. However, we haven't seen tremendous inflation because people are just saving the money, not spending it. In fact, you noted that checkable and savings deposits at the bank have grown from $4.7 trillion to $9.9 trillion. And you say that if the Fed introduces negative interest rates, people will take their money out of the bank and start spending it. Did you want to discuss a little bit about this and how this will cause inflation?
Yeah, I think there are two things to consider here with negative interest rates. The dollar is unique amongst currencies, being the reserve currency, being the currency in which all commodities are priced. So the moment the dollar, the Fed, if you like, introduces negative interest rates, that will drive all commodities into a basic position of backwardation. Now, what we mean by that is that it is cheaper for you to hold raw materials, whether it be copper, silver, gold, aluminium, oil. It would be cheaper for you to hold those raw materials than to hold dollar cash, because your dollar cash, in effect, would have a tax, which is what a negative interest rate is. So you can see that that would change the relationship between the currency and the commodities quite sharply, in a way which just a fall in positive interest rates wouldn't necessarily generate. That's the first thing to consider. The second point to consider is that all the deposits that have been created by the issuance of credit, the credit, by the way, is being applied to financial markets rather than the ordinary economy, if you like, the part of economy which is included within GDP. The result is financial assets have risen in price, if you like. There's been inflation there, but there hasn't been a matching inflation in any way amongst the sort of the products and services that people buy day to day. Now, if you introduce negative interest rates, then what you do is you risk changing the preference that people have on balance for holding money compared with goods. Now, these people are not just consumers, they're also the producers, because we go and work in order to earn money so that we can buy the things that we need and want, if you like, in the normal course of our daily existence. So it's not just the consumers who suddenly don't really want to hold on to the cash, it is also the producers. Now, we're looking at two sides of the same coin because we are both producers and we are consumers. But what that means basically is that on the margin, producers are not going to want to hold cash quite so much, and the consumers are not going to want to hold cash quite so much. So the inevitable consequence of that is that the prices of the goods and services that we buy day to day are bound to rise because of that change of preference. So what you have is not so much demand created by negative interest rates, though on the margins there was, that is quite likely that there would be some demand created. But what you're far more likely to see is really what was coined a long time ago, stagflation. In other words, a mixture of a stagnant economy, yet persistent inflation in prices. And that is not a nice outcome, and it's a very difficult one. In fact, it's an impossible situation for central banks to control without raising interest rates to the point where suddenly there is a switch back into preference for money. And that basically means raising interest rates to the point where you then get a real slump in economic activity.
Did you want to explain a little bit more about why negative interest rates would only cause inflation and not rise in economic activity? Because it seems like if people were spending more money, wouldn't production and economic activity catch up with consumer demand?
The point is that both as consumers and producers, which we both are, our preference for holding money relative to goods changes. What we're talking about is, if you like, the liquidity that we have in our bank accounts that we spend over the course of a month, if you're paid monthly. Now, if instead of holding a cash balance at the beginning of the month, you decide, well, what I would rather do is to spend on the credit card, what you're doing is you're reducing your overall cash balance. Now, this move away from holding, let's say, net cash, if we can put it that way. I know I'm oversimplifying in a sense. From holding net cash to holding less cash, or even running your day-to-day affairs on credit cards, in other words, on a sort of a borrowing basis, then what you're doing is you are increasing your preference for goods compared with cash. Now, if a producer is in exactly the same position, he feels less keen to hold cash than he does to sell his goods, then on the margin, he's going to raise his prices rather than compete with lower prices. So what you end up with is higher prices without the underlying increase in economic activity. And that is stagflation, and that is the situation which I was describing.
Now, you also talked about in your article that the Cyprus banking crisis and what happened there in 2013 was kind of a foretaste of what we could see if the United States implemented negative interest rates. Did you want to discuss a little bit about this?
Yes. Just to refresh your listeners' minds, Cyprus had a banking crisis back in, was it 2013, I think it was. It was February 2013. And basically, the banks were bailed in. But as part of that, the banks were shut for a good 2 weeks. Now, this created quite a lot of alarm amongst depositors in other banks, particularly depositors in banks which were based in Spain, Italy, Greece, Portugal, and so on. Now, what they wanted to do was to move their deposits out of those banks because they could see there was a risk, which they were suddenly a bit more alive to move those deposits into banks which were slightly better found or in jurisdictions where they felt it was a bit, more safe. And so you had capital flows from Italy, Spain, Greece, Portugal, and so on, into particularly Germany and to a lesser extent Luxembourg. And it was the banks there that picked up these deposits. Now, everybody was aware of that, and this is all reflected in the Target 2 imbalances, which are routinely published by the ECB. What people were not aware of was that people who had bullion accounts with bullion banks decided that they either wanted to take possession of the bullion themselves rather than risk it being held within the banking system, or alternatively, where they had unallocated accounts, that is, an account which is an entitlement to bullion rather than owning bullion itself, they wanted to move that from unallocated to an allocated account. Now, allocated account is where the bank effectively acts as custodian for a third party's gold. The banks, two banks in particular, refused to do that. One was ABN AMRO and the other was Rabobank, both these Dutch banks. And that was the first and most public sign we had of this problem developing. It was shortly after that that a decision was taken to hit the gold market, remove all bullishness from it, and in the process unlock the liquidity which was all sitting there waiting to be unlocked in the GLD ETF and also other ETFs, physical ETFs. And that broadly was a very successful, very cleverly executed move. And it was in April 2013 that the gold market had that very, very big smash down. There's no doubt about it. It was orchestrated by the central banks who warned the market that it was coming. And the reason they would warn the market that it was coming was simply to get hedge funds and other dealers on side selling alongside themselves. And that's basically what happened. We now have a situation today where if we impose negative interest rates, people are likely to try and move their money out of the banks, either into cash notes, which is why all the talk about banning cash is so much in the news now, because central banks would not want to see people escaping negative interest rates that way. The other way they can do it is they can sell their dollars or euros or sterling or yen and buy gold with it, physical gold instead, and pass on the negative interest rate problem to someone else. So the effect of this is that any attempt to hit the gold price this time round is going to have to contend with a far wider public demand for gold. And at the same time, the other point worth mentioning is that the amount of gold that is actually left in Western vaults is considerably less today than it was in 2013. So central banks embarking on a policy of trying to knock down the gold price actually have far less ability to do so because the physical stock just isn't around to deliver.
Before we let you go, I was wondering if we could touch on one last topic. Now, in the United States, it seems like we're seeing the stock market roll over. Now, did you want to discuss a little bit about this? And also, in Europe, what is happening to the stock market over there?
Well, all stock markets are sort of more or less moving in phase, with the probable exception of the Shanghai stock market, which has really had a very, very nasty hit. And broadly speaking, I think the problem is that we've got to the stage where ultra-low government bond yields are telling us not that interest rates are very low and this is a good time to buy anything with a yield, which has been the mantra so far in equity markets. But this is a market which has an awful lot of risk. And the reason that we will take negative interest rates on 10-year German bonds is simply we don't want to risk our money anywhere else, which is a very, very different emphasis. And I think the principal problem behind this is that while we see interest rates so low, these are not the interest rates that companies pay. Companies pay higher rates. And if a company has too much debt for its business, if you like, to carry, to service, then that company is in trouble. And this gives us a clue as to what's happening, because the slowdown in the global economy, as evidenced by the very sharp decline in cross-border trade, tells us that the corporate sector worldwide is actually not doing very well. It is also overburdened with debt, and this combination is quite lethal. So what you have now is a situation where these companies' priorities are to pay down its debt rather than to increase its trade and trade its way, sort of generate the income, invest in the business, take on more debt to generate more income. Those days are no longer here. You've got too many people with too much debt, and the result is that the global economy and also the US economy is sinking under this enormous debt burden.
Well, Alasdair Macleod, thank you so much for joining us today. Now, before we let you go, we always like to, just for our new viewers, to let them know, your opinion on how people can protect themselves from what's coming. We're seeing possibly negative interest rates coming and then massive inflation and possibly a stock market crash. How do you see, in your opinion, that people should protect themselves?
Well, I think I don't give investment advice, but my personal view is that people would be foolish not to have some sound money tucked in under their belt. And sound money is gold. If you want to speculate a bit on sound money, then you could probably go for silver, because silver broadly, though it hasn't been doing this recently, it broadly rises or falls at twice the rate of the gold price. But I think that would be my underlying tip. I mean, life goes on. We can't assume that the world is going to come to an end, but a little bit of insurance, I think, does make sense.
Alasdair Macleod, did you want to share with the viewers where they can find you?
Yep. Goldmoney.com, www.goldmoney.com, and finance and economics, one word, .org.
This video was brought to you in part by ReluctantPreppers.com. Click here to watch Reluctant Prepper's latest interview with Ann Barnhart. What signs indicate we are on the edge of the precipice? Founder of the former Barnhart Capital Management, outspoken critic of unconstitutional government and lawless economic power systems, Ann Barnhart returns to Reluctant Preppers to sound the alert of clear and present danger evidenced by the patterns of power and megatrends across major spheres of concern that signal we are on the verge of a cataclysmic social, economic, political, military, moral, and spiritual collapse. Buckle up and get ready for an eye-opening briefing.